Peter Rose, Longwood Currency Trading. Good morning. It's a Cinco de Mayo in the United States, celebrating May 5th of 2022. And it's a bright, warm day, although it rained yesterday, so I'm not going to do this outside. $6,200 gain on size. I want to talk to you about how that came about. You know, I did a video not long ago. I think it was a $3,600 gain that I considered a loss, and it was because of the time holding period that that I had to hold that trade over to make that $3,600. It was a 90-day hold, and so it reduced the daily value of that trade, because you have to count Saturdays and Sundays for your holding periods, to be little bit, maybe just a little bit over, a little bit less than what I can normally make on a day that I actually did trade. You know, like on a daily basis, a day trading basis. So if you trade 4 or 5 days a week, whatever that is, and you add all that up and divide it by the total number of days over the sample size that you traded, because you have to keep the number of days the same, then that differential was pretty small. And I went over that and I said that's why I considered it a loss, because of the added risk that I had to take in order to get that $3,600 gain. I was more than $3,600 underwater many times during the course of that 90 days. In fact, I was significantly underwater. But I didn't want to lose my position because I felt good about it. In this scenario, making $6,200 or $6,300, I forget what it was, the holding period, again, it was a longer term trade. It was a 6-day trade. So, you know, now I'm looking at much more significant per day gain that I probably couldn't have made trading on a daily basis with the size of bank that I had at that particular time. But the point of the story is that in working with this particular trade, I was so confident in where I felt the market was going to go. And this particular pair that I was trading, I felt that it was going to undergo a significant decline. Now, we never know when that's going to happen, but with experience, you can say these movements indicate these economic conditions, these, you know, siren songs are indicating that the high probability is that the price will not only go down, but it should react and go down significantly. We don't know when that's going to happen. And so you take your position. In this particular instance, I increased my position size by 40%. It was around 40%. I increased the size. That was a significant increase in the size of my position, but that was in well, it was in harmony with my general feeling of where the market was going to go. Now, as a result of doing that, I actually made 150% more on my gain because of that size increase over what I would normally be trading for size. So the point that I want to bring out here is that it takes money to make money. And I've said this many, many, many times for those of you that are starting out trading 3 mini lots or whatever. You can't trade for the dollars. You have to trade for the pips and build your ability, your experience level up in the trading, so that when you do get this feeling based on instinct, I mean, I'm not talking juju here. I'm talking, as Curtis Faith would call it, trading from the gut. And with experience, you get that. Well, if you don't have that experience, then you can't be doing that shit. You can't be holding trades for big losses in anticipation that you're ultimately going to be right. You have to do it differently. And so, though I'm a day trader, and this channel is about helping folks get started with small accounts to gain their experience so that then they can back the truck up with the bank and dump more money into the account and then make those gains. So by increasing the size of my bank by 40%, let's say you're trading with 6 minis, okay? You get a $6,000 account, and then you jump it to a $10,000 account, trading one full. That's a 40% increase in the size of your bank. But then your profit goes from, if you made 10 pips on 6 minis, you made $6. If you make it on 10, then you make $100. So now you're making this considerable increase in the dollar amount that you make on the same pip change, right? And so that's been my premise all along. And I'm not bragging about making $6,000 here. I'm simply making the statement that this is how it works. When you increase your bank size, your dollar amount goes up more than the percentage of your bank size increase. And that's the magic of it. And when you get more experience and you add compounding into that, the results can be spectacular. The thing to keep in mind, however, and I caution traders about this, I don't compound my positions. Even trading with a 6-figure account, I don't compound my positions. I compound only when I have enough money to add another lot or another 2 lots or another 4 lots into the mix. And I always want to have enough dry powder. If I'm going to trade with 3 or 4 or 5 full lots, I want to have 8 or 10 full lot capability. Because when you get in these trades and you're staging, which is not something that beginners or people with less than a year or so experience, we got to have a couple of hundred trades before you start staging. But that gives you the ability, as you're staging into your position, that all of a sudden you get to the end of the amount of money that you have available for the trading. Let's say you've been trading 6 minis. Let's take my example, because I'm trading 6 fulls, okay? And you stage those in, and you got a full load, and then the thing really moves against you, and you go, well, I'm going to hold this past my profit target, but I got no more dry powder to add to the trade. And so I did, trading those 6 fulls, and so I went to 10 fulls. And that's exactly what happened with this particular trade. I got in with, I think I started the trade out with two lots. I went in with 2 lots. It went in my favor. Well, I added 1 more lot to it. And it went against me, and it started to come back, and I added another lot. So I'm staging in, and I'm working through this trade with the expectation there's going to be this tremendous reaction at some point. The problem with me is 40 years of real estate investment, and I'm not copping a plea to anybody. I have this built-in instinct for real estate and how to make money in real estate. In real estate, I lost $1 million twice in my life of real estate net worth, but I didn't lose the asset. I didn't lose the buildings. There were economic conditions, crises in the markets where everything just fell apart. I've told the story many times about the condo that I lived in before I moved into this house. It was worth $250,000. I know enough about real estate. I'm not saying, well, I got $250,000. At the time, it was $250,000. Now you're listening to this now and you go, well, that was a pauper's condo. No, $250,000 was a really substantial price for a condo back in the day. This is It's 2022 now. This is probably 2015. Okay, and then we ended up in a relatively big slam. Maybe it was 2014, and the condo lost 40% of its value. It went to 150. It was a $100,000 loss. But I didn't lose the condo. I just lost $100,000 of value on that particular building. I had buildings that were, that would lose $400,000 of value in their evaluation, and so each time that I got taken to the wood and losing $1 million net worth, I got that back by either buying another building and adding, by staging in, or allowing the compounding effect of the value of the real estates to appreciate. And so, but that took me 10 years each time that happened to build that back up to where it was before the crash. Listen, if you lose 50% of your money, you've got to make 100% back on the money that's left in order to break even. So that's what's difficult about real estate is, it'll come back if you've got the patience to hold, if the value doesn't fall below the mortgage amount, so the bank calls your loan, all that sort of thing. Well, currency trading is the same way. I mean, you can lose so much money on your trade that you go below the margin, required margin that you need to have, and the broker will close you out your position. That's why you've always got to have dry powder, or at least not over leveraged in your trading, so that if the thing goes massively against you, today, I mean, I just got taken out and made the $6,200 today. That movement happened in about an hour. Just corresponding to that, the day before, the market went in exactly the opposite direction, and I was $10,000 bad, but I had enough money in my account that the cost of holding versus the amount of money that I had left over as a runway was sufficient to withstand a $10,000, $12,000 negative position. And I held that position because I was confident that price was going to turn around, and because it spiked up so much, and that I was so far down, I was down a lot further than 12,000 at one point because of this enormous pin bar spike that occurred. I said, this is not right. The time has come. All we got to do is hold on. Hold on to your ass, and you got to have persistence and not lose your position, and this thing should work out. I'll tell you right now, it went 17,000 against me in that one thing. I was watching a movie last night. Just didn't matter because I knew the end was near. I woke up this morning. I was standing here pouring a cup of coffee, talking to my wife. My phone goes bing. What the hell is that? You gotta remember, I was $17,000 behind. I go in to the market, and boom, $6,200 gain. So it went from a $17,000 negative to a $6,200 gain. So you'd say, "Oh, your risk was so out of line for the amount of money that you made." No, it wasn't. No, it wasn't. Sit down. I made $6,200. I could have lost 17. Yes, you're exactly correct. So, $17,000 loss with the size of the ultimate bank and the additional runway that I have is not a significant enough loss to lose your cookies over. It's a lot of dollar value, but the PIP values are proportional to what you'd be experiencing if you trade a fucking mini lot. So let's be realistic here about where we are in relationship to our experience level and what you're doing. What makes me a good instructor or teacher is the fact that I have the experience to tell somebody, don't do this now. Don't do what I just did when you're trying to learn what's going on, because your instincts aren't going to be there. Your experience isn't going to be there. Folks with the size of accounts that I have are not doing what I'm doing because they're only taking 0.25% risk on their money, or getting out at 1% loss if they lose 1%. Their stops are there and they lose the 1% for the day, and they get out. But if you're going to look for the big gain, it's you can't get out. You can't lose your position. And that's why I like the day trading over the longer term trades, because you want to be flat at the end of the day. So no matter how good that position, well, if the position is really going good for you, you can trail a stop, but you're not actively staging in and doing all this other kind of stuff. You're in there for a day trade. You're in there to go in. If it doesn't, when you get experience and you're day trading, you may go in with 30% of your bank. If it goes against you, you get out with that 30% of your bank loss, short loss, okay, 8 pips, 10 pips. However, if you have a good win to loss ratio, you can lose 3 or 4 times, excuse me, on that short loss, and more than make up for that on the times that you do win, because you have to have good metrics, good trading metrics. And so, because I have a good win-to-loss ratio, I mean, I didn't really expect to be $17,000 behind in the first place, but that's a good thing because it just showed the asininity of the retail traders that were causing that to happen. I mean, it's the retail traders. We're providing the fodder for the institutional traders. That we're providing that last liquidity that they need in order to make stuff like that happen. You don't think it's the retail traders that are causing these 50, 100 pip moves in 15 minutes, do you? No, that's the institutional traders feeding the goose. And then the goose just goes around and gobbles it all up and drives the price way up. And then the institution says, we're done, and sells everything. And everybody stops out. And the institutions pick up the difference. The institutions in the last 6 days have picked up 500 pips. Now, they had to average into that, but they picked up 300 anyway, and the gyrations that were going on. I just got caught in one of the second to last major retractions. Actually, I got caught in the it was the third reaction that I came back off of that I made. I went through 2 spikes, and I just said, I'm not getting out of this. These guys are seriously big enough, putting together some inventory, and I'm just gonna. If I get out, I wouldn't know where to get back into my position. For example, right now, I picked my profit target really well. The order went off, $6,200. The thing is still going down. But that's as far as I wanted to go. And I'm not in the trade looking for the last 10 or 15 pips more, or to load in and go in for 3 or 4 or 5 more lots just to pick up another $400 or $500, because the risk is too great. And therein lies one of the other problems in being a long-term trader is that you have to be so very, very careful about where you put your profit target and not to try to be too greedy. Because, well, I'll tell you, in this trade, I had an original $2,800 profit target, right? But I wasn't trading with my full size. I had just gone in and had that as a profit target. And I was in profit, I don't know, $1,100. What I should have done is go, oh, that's great. They're feeding me this $1,100 gain. I'm going to take it and go. Because right after that, the price came down to within 5 pips of my $2,800 profit target. And then it went, let me see, it went 150 pips against me. So you have to be very cautious of how you're putting these trades together. What's the theory behind it? What are you basing it on? And again, as I said, you got to save your opinions for movie reviews. And that's my problem. I shouldn't have taken the long view. But I saw so much money laying on the table. When this thing goes, it's going to go big time. So you get $6,200 and it takes you 6 days. Let's call it $1,000 a day. So that's pretty good money. More money than I would be able to make trading that size account on a daily basis under good risk control. But when you see the money laying on the table, you back the truck up and go all in, and don't be getting shy about coming out. So in the instance where I had the $3,600 gain over the 90 days, I consider that a loss. The $6,200 gain in 6 days, that's pretty good. However, the risk that I had to undergo to get that is problematic, because at some point, I'll be wrong, and it won't be. I don't think that I'll be wrong on what ultimately will happen, but I'll be so significantly wrong on when that's going to happen that the pain of the loss will be so great that I'll just have to get out. And with that kind of, that was Jesse Livermore's process of trading. He'd have an idea, he'd have a concept, he knew what he wanted to do, and he went all in. And he would never get out of the trade, because eventually he'd be right, because he was that good. But the times that he was wrong, he lost it all. He made 6 fortunes. I think that it was 6 fortunes in his life. And each one of those fortunes was more money than probably, I mean, it was the equivalent of $6 or $8 million today, or $20 million today, each time. During the great the stock market crash of '29, he made the equivalent of $1 billion. And he had a very high lifestyle and all that other kind of stuff, but he was also trading and betting. He lost it all. Lost it all. But with a little bit better money management and putting some of that money off on the side, I mean, I think at one point he put $1 million off on the side for his wife. Don't ever give it to me. And I don't think she did. But from what I understand, he died basically broke. So it's a different way of managing risk. But the thing that he didn't do is he didn't take some of that money off the table and put it to the side. Even in the beginning, when he was trading and he'd lose everything. He had nothing. He had to go to his stockbroker, who had a lot of confidence in him, and borrow $500 so he could get started again, because he didn't even have $500. And the guy knew he was a good trader, gave him $500. And from that, he built another one of these fortunes. So we can read the books and we can study what these astronomically talented, lucky traders have done, but you can't mimic that, and you have to be very careful. I have to be very careful because I have too often let the real estate risk management philosophy come into my currency trading, and most of the time it works. I had a situation when I was starting with a relatively big account, and I got margined out. And right after I got margined out, within, I think it was 5 or 6 days, the thing just went, and it was like somebody set off a rocket. And I would have ended up, 40% increase on my bank size. So I'm very hesitant to think and pat myself on the back that I made $6,200 because the risk was so extreme that it could have gotten out of control. And, well, it was out of control. Okay. Because one day I'll get that wrong. Well, I have enough experience at this now and understand how to avoid doing that. And the only reason I got into this is because, again, as I've said in one of the earlier videos that I did, this is early May of 2022. So the first 2 months of the year I didn't trade, January and February, because I had a carry trade from 2021. That was the one where I made $3,600. That didn't happen until March. So I've only traded March and April. And I had 15 trading days that I traded. There's 40 trading days available in March and April. There's 20 trading days a month that you could trade, and I only traded 15 of those days, and I have not had a losing day in those 15 days of trading. I said the other day, my least was I made $12 for the day, but it was positive. I rang the cash register. Most of the days were $300-400. On the size account that I was trading, that was good money. It is good money. People don't make $300 a day, for Christ's sake. You're looking to make $160 a day. So, in looking at the management of the money, and now I've added even more money into the account because I'm going to be increasing my size, and I'm going to be doing that gradually. This last trade was not a gradual increase in my position size. So the next trades that I'll make are going to be structured a little bit differently. They will be day trades, and they will be less dependent on the when that economic events are going to manifest themselves, unless I absolutely see something laying on the ground, and I'll pick that up. And I'll go back and I'll trade, even with this larger size, I'm going to go back and trade with my normal trading size. In fact, I'm probably going to go down in entry size because I feel that I'll be taking more losses, so I'll take those on that smaller amount, and then I'll be staging in to the larger figures to get a standard position size. And if the thing begins to exceed, then there's a whole different theory of staging that I'll begin to implement. Most people teach staging the wrong way, and so and you have to, when you're learning how to stage, you have to stage that way. But there's a better way to do it. Oh, that's an advanced course that I have. An advanced course where I go over compounding and staging, and there's only like four things. but they're very complex and they're very specific in where the risk lies. So you have to be really careful about that. And so that's what's covered there. But all I'm trying to do here is kind of lay the foundation work for you as to when you're starting out, there's certain things that you need to do to learn, to gain the experience, so that when you're ready to add more money to your account, you've got the experience to manage that money in the same manner until you get even more experience and you have more money, and then you have to learn how to just make some slight shifts to transition in what you're doing so that you don't lose sight of your risk management. And holding trades way beyond where you got to say, well, I don't want to lose my position, is not the way to do it. There's a better way to do it. And but this was just going to be so spectacular. I don't think I would have made the $6,200 if I would have waited for this crack to happen and go. It probably would not have been as much. So, and that's what that's that fear of missing out, right? That's why you do stuff like that. So I'm not advocating that. All I'm trying to do is show you from a day in the life of the trader, these are the issues and the things that we come in contact with. These are the decisions that need to be made. And if you don't have a really solid strategic approach, several different strategic approaches based on not only the life cycle stage that you're in the trade, but also what's happening with the price action. And each one of those strategies has to have a series of rules. And those rules are kind of binary. If this particular thing happens, you're either going to do this or you're going to do that. And each node forms that so that you have a limited series of rules and basically a simple straight line path through those rules based on the conditions that are appearing at the given time that you're talking about in your head. Well, what do I do at this particular trade based on this type of price action, right? And so don't get enamored with my $6,200 gain, because that was done on a really big size, and it was done on increasing that size by 40% over what I was normally trading. But when you have experience, even if you trade in minis, you could do the same thing, and you can have the same results. It's just not going to be the same dollar amount. If you're expecting, with a year of trading, that you're going to be making $5,000 a day, you're crazy. What you're going to do is lose $5,000 a day. That's what you're going to do. So listen to my videos, and if you're new to the channel, don't just start with this video and move your way forward or go back 4 or 5. Go back to the beginning. I've got I think this is my 205th video that I've put out. That's a lot of videos. But you know what? You don't want to take classes from me. You don't want to take consulting from me, because it's going to be a lot of money, thousands and thousands of dollars. And so if you go back and go through the videos, if you're able to, you can pull out the nodes and the pieces and put those together and do it on your own. I'm not sure that's going to be a successful methodology for most people, because they're not trained like I am as a software engineer, and my degree in physics is how to break complex problems up. I break those problems up, but there are over 200 videos. So if you watch one video and you get one concept out of it, then it was worth watching that video. If you've got time to watch 200 of them, God love you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.